Welcome to The Explainer. For decades, the American coffee market has had one undisputed king. But now, that throne is starting to look a little wobbly. Today, we're diving deep into the 2025 coffee wars, where a legendary giant is facing some serious heat from two incredibly fast-moving challengers.
Let's kick things off with just one number, 877. That's the number of stores Starbucks closed down in a single year. Now, that isn't just a random statistic. It's a massive signal that the ground is shifting in the battle for your morning cup. So here's how we're going to break it all down. First, we'll get to know the three main players in this fight. Then, we're going to follow the money and see who's really winning on paper. After that, we'll uncover the secret weapon that's completely changing the game, the drive-thru. And finally, we'll look at this from an investor's point of view. What are the real risks and rewards here?
All right, so for what feels like forever, the world of coffee really just revolved around one green logo, right? But that is changing, and it's changing fast. This isn't a monarchy anymore. It's turning into an all-out battlefield.
This analysis from HDIN Research really frames it perfectly as this classic three-way fight. First up, you've got Starbucks, the defender. They're the reigning champ, protecting a massive empire. Then you have Dutch Bros, the challenger. They're expanding everywhere with a battle-tested game plan. And finally, you have BlackRock Coffee Bar, the emerging disruptor. They're the wild card, moving at lightning speed on a mission that's all about high risk and high reward. And you know, this is so much more than just a battle of brands. It's really a clash of philosophies. On one side, you've got that comfy, familiar third-place vibe that Starbucks absolutely perfected. They're not just trying to fine-tune that giant global machine. And on the other side, you've got the pure, raw speed of companies like Dutch Bros, whose entire reason for being is to get you a great coffee, like, right now. Okay, let's follow the money. Because at the end of the day, this is where you can see how those different strategies actually translate into dollars and cents. The numbers don't lie.
So this chart is all about raw momentum, revenue growth. It's basically how fast your sales are climbing. And wow, look at this. The challengers are just playing a different sport. Dutch Bros grew almost 28%. BlackRock is right there with them at nearly 25%. And then you have Starbucks. 3% is steady for a giant, but it tells a completely different story.
But hold on. Before you go writing off the giant, you have to get your head around this number. $37.2 billion. That is Starbucks' total revenue. The scale is just mind-boggling. They make more money in 2 weeks than their biggest challengers make in an entire year. It's a different financial universe. But being that big brings its own problems. And this next number, same-store sales growth, is absolutely crucial. It basically ignores all the new stores and just asks, are the existing shops doing better than last year? And this is where the story completely flips. The challengers are on fire. BlackRock stores are up over 10%. But look at Starbucks. Their existing locations actually went down 1%. That is a major warning sign. And all of this leads us to the bottom line, actual profit. And right here, the trade-offs couldn't be clearer. Starbucks, yeah, it's growing slower, but it's an absolute profit fortress, raking in almost $2 billion. Dutch Bros has hit that sweet spot. They're going fast and making good money. But BlackRock, they're firmly in the red, burning through cash on purpose to grow as fast as humanly possible. So how are they pulling off these numbers? Well, the real action isn't just on a balance sheet. The real battlefield is the drive-thru window.
You can't really get what's happening here until you see this quote for Dutch Bros' own financial documents. 85% of their business is drive-thru. Think about that. It's not just part of what they do, it is what they do. It's their entire model. Their secret weapon is pure, simple speed. And that drive-thru focus is a massive advantage. It means you can serve way more people during that insane morning rush. Your costs for real estate and staffing are way lower, and you can even try new things, like how Dutch Bros sends runners with tablets down the car line to speed things up. It's a lean, mean coffee-making machine built for the way we live today. So what's the king's counterattack? They're going back to their roots and doubling down on their strengths. This Back to Starbucks plan has 4 key parts. 1, they're trimming the fat, closing those hundreds of weaker stores. 2, they're getting way smarter, using AI to manage everything from staffing to inventory. 3, they're reinvesting in their baristas to improve service. And 4, they're focusing on getting more out of the stores they already have, not just building new ones.
It's really the perfect analogy. Think about a veteran quarterback. He's not going to win by trying to outrun the 22-year-old rookies. No way. He wins by using his experience, his intelligence, his fundamentals. He plays a smarter game. And that is exactly what Starbucks is trying to do here. Okay, so let's put our investor hats on. If you were going to put your hard-earned money into one of these companies, what exactly are you buying into? What does it all mean for your portfolio?
Well, from an investment standpoint, these are three completely different animals. Starbucks is your blue chip stock. It's the safe, steady fortress that pays you a dividend. Dutch Bros is your balanced growth play. They have a proven model, they're profitable, and they're still expanding like crazy. And then there's BlackRock. That's the lottery ticket. It's a high-risk gamble on absolutely explosive growth, but its financial footing is shaky.
And to understand just how risky that gamble is, we need to look at one key number that the HDIN Research analysis really zeroes in on. It's called the interest coverage ratio.
Now, don't let the fancy name fool you. The idea is actually pretty simple. Imagine that your monthly paycheck doesn't cover your mortgage and your credit card bills. That's a scary situation, right? You'd have to dip into your savings or borrow even more money just to stay afloat. Well, that's exactly what this ratio measures for a company.
And here it is, the big red flag. BlackRock's ratio is less than 1. That means right now the company is not earning enough money to even cover the interest payments on its debt. It's surviving on the cash it raised from investors when it went public. It is a genuine race against time.
And you know what? The market has noticed. Just look at its stock performance. Since going public, BlackRock has seriously underperformed the rest of the market. Investors are nervous, and you can't really blame them. A business that's burning through cash is not what people are looking for, especially when borrowing more money is so expensive.
So, to wrap it all up, you have three totally distinct playbooks in action. Starbucks is fortifying its castle, betting on its brand and efficiency. Dutch Bros is leading a very disciplined invasion across the country with its high-speed model. And BlackRock has basically strapped itself to a rocket, hoping it gets to orbit before it runs out of fuel. You know, this coffee war is far from over. The defender is getting smarter, the challenger is getting bigger, and the gambler is letting it all ride. It all leaves us with one final big question. Whose strategy is going to win your business, and whose cup will you be drinking next year?